Welcome, everyone. You are in a joint webinar organized by Franklin Templeton and futusg Singapore, the Moomoo training app.
Franklin Templeton, we have about 130 billion for multi-asset. We've been managing multi-asset for more than 70 years. So I'm looking forward to have a discussion with you all about all the macro risks that we're seeing and where we are overweighting or underweighting in terms of asset class.
And what about you, Eugene?
Well, I'm the vice president of financial institutions. My team works with retail distributors like yourselves, Futu and Moomoo, to articulate views of our products, articulate our macro views, and to maintain the relationships with distributors all across Singapore. So that's.
Well, welcome. And we are very excited for the next 2 days, including today, on the topics that we're about to discuss. And I think the viewers watching will definitely benefit with what you've got to give. So, Stephen, I would like to ask you and open the discussion for this really important topic. Now, for the viewers who just joined us, today we will discuss the rising uncertainties and how to effectively asset allocate one's investment portfolio with regards to the investment implications of the Russian-Ukraine conflict. Now, the first question, what are the macroeconomic implications of this conflict?
Well, yeah, obviously, what's happening, what's going on in the Ukraine is tragic. No one wants to see, a conflict like this. And we might have thought, we are in a peace for a few decades. But if you look back into history, actually, geopolitical tension like this happened actually every 3 to 5 years over the last 2 decades. So we've put together a chart, if Eugene can put this up on page 1. I mean, if you look at it, every 3 to 5 years, there's ups and downs for these geopolitical risk. If history is of any guidance, I mean, if you look further back, it is, actually a good time, if you take a 12 to 18 months kind of perspective on the equity market. But, the period during which is definitely not easy to navigate. And we are more than happy to take a deeper dive into the implication to some of the asset class. So if the thinking process that we have is on the next slide. So 2 parameters that we've been thinking about during this crisis. One is what is the implication on growth, and the other is what is the implication on inflation. These 2 obviously are interlinked, and we believe these will be the major sort of like the factor driving the global market ever since we have the COVID drawdown. So 2020, 2021, I'm sure a lot of your client on this app or a lot of the retail investors are enjoying the tailwind that we have in a lot of the equity market. It's one of the strongest, fastest bull market that we've seen. But now when all these like tailwind become headwind, these are some of the things that we need to think about. For example, being one of the major exporter for commodity for both Russia and Ukraine, right? Now, on food, on energy, right? How much further will investment go up? Every day you go out and get your oil supply for your car and energy consumption, the bill just go up. In the US, the data is just out, about 8% inflation, which is something that they have not seen for over 40 years. So, how much further can we go up? And to what extent this will affect the growth potential? Now we're starting to see people talking about, hey, will we see a stagflation kind of situation where we have more of a inflation but not much of a growth? If that is the case, then risky class, even the valuation has been down a lot, could still be tricky. So these are all, at the end, to our mind, will affect how central bank is going to change their policy. The pace of it is something of question. The direction of it is not. So we all know, all the central bank in most of the developed market is going to do rate hike, but how quickly they are going to do that, and what is the pace that they're going to do that is something that we need to think about. And if they are more hawkish than people think, then it might be a tailwind for a lot of the risk asset.
Mm-hmm. And then in terms of impact, what does this event impact in terms of, for example, oil and commodities? Because you talk about tailwind, and I think, there are different camps out there, right, in the discussion groups online who would like to know how that affects them in terms of impact.
Yeah, and so, we sort of like have a framework to look into it. So you can move to the next slide. So to us, again, it's more like a 2x2 matrix between like growth and inflation. Right now, and 2 months seems a long while, but if we think about like as we enter this year, we are talking about having a high growth and high inflation. So, to that end, people are thinking about equity, commodities, or credit will be the asset class that could be benefit in this scenario. We call it reflation. But now, as we, sort of like have more doubts about to what extent growth can persist, especially in the Europe market, or even to a certain extent to the US market, that becomes more like a low growth, high inflation, and that turns into lower right quadrant about, hey, maybe commodity or something that can help you to hedge against inflation, like tips, could be something under benefit. But you can see in these scenario, right? Fixed income is not something that you will see that will be benefit. So, a lot of the client asks us about, hey, is it a good time to think about like, moving out from equity and going into fixed income? Normally, you might think it is, but the challenge is, given a 10 years treasury just give you nothing more than 2.1%, the problem is you still get a negative real return after discounting for inflation. And the direction of rate hike is not changed. So, net you might just have a negative return. And as a result, you still might need to take a little bit of risk into the portfolio, which I know a lot of the investors are not feeling comfortable given the market drawdown on a day-to-day basis.
Mm. And what would you say for retail investors side? What is one key thing they should look out for in terms of impact?
Well, a lot of the retail investors, they focus a lot more on the equity. So we might, just take a deeper dive into it. I think one point that we shouldn't let our eyes off is, when we enter this year, the focus are all about the central bank policy. And liquidity is still one of the major reasons why we have the multiples or the valuation that the market has today, even after the drawdown. And this is important because obviously, Russia, Ukraine, that's tragic, that's bad event. No one wants to happen and it will affect inflation. But at the end of the day, to a lot of the market like US, the direct exposure to Russia are limited, and it will be far more, affected by the inflation expectation and the growth. So if you look at the next slide, we sort of like put together what is actually, say, US equity is going to behave like, in sort of like the past few rate high cycle. And to our research, it's only mainly two factors. One, when we enter into this inflation, are we rate high cycle? Are we at a high inflation or low inflation? And the pace that the Fed would like to do the rate high, are they looking for a quick cycle or a slow cycle? The combination of the fast cycle and the entering inflation is high. The combination of these two normally will have the worst impact to S&P 500 or the US equity market broadly. And this is the assumption that we've been having as we enter 2022. Now, things is being changed, especially because of the geopolitical things that we've been seeing. Maybe there are chances that we will see the pace of the Fed rate hike may be slowing down. And if that is the case, we will be tilting away from that worst scenario. And that could be supportive, or tailwind to the US equity market. And to that end, even if we look at the equity market right now, so on the next slide, you can see there are always like winner and loser even out of this particular market, right? A lot of the people are talking about, hey, it's time for value, and go away from growth, right? We sort of like get that if you look at, the high level snapshot of where we're having. But that is like, to us, a lot oversimplifying on what's going on in the market. Even, if we take a deeper dive into some of the sector, which is on the next slide, about what is doing well, what is not doing well, you see that, there's not much actually are doing well. And energy is by far one of the sector, if any, that actually pull up the whole S&P 500, 27.6%, year to date as of the early March. All the other asset classes, even financial, you might think, we benefit on a rate high cycle. They are down. Not to mention about all the growth or technology sector, which are down by more than double digits. So, to us, when we do the sort of like allocation, in addition to how we see the macro, bottom of selection plays a key role to that. It's important to identify a company that can still make money, have a positive cash flow in these circumstances, because at the end, there's only two factors that would drive up equity valuation. One is about earning. Are they making any money at all? And two is, what are the markets multiple that is being given by them? Multiples are going to be bad across the board simply because where we are having. So it's important to identify, look at your list to see which company are actually making money. And, those companies that struggle to make money out of, free cash flow, positive cash flow are going to be the first stream of stock that is going to be trimmed by investors. So this is, how we are looking at some of the winner versus loser at the current market.
And just for the viewers out there, in terms of equities and bonds, right? What you just covered is how they behave over the short term. So is there anything else they can look out for in terms of long-term, behaviors in this space?
Yeah, well, longer term, obviously things could be quite different. If we have a 6 months, 6 to 12 months, kind of more like a longer term view in terms of where we are for these asset class allocation, we still want to remain resilient. There are a few reasons, right? First of all, it doesn't earn much, for owning fixed income, right? There may be some opportunity in terms of high yield as we see the spread are improving, the defaults are not getting anything worse. So the developed market of US high yield is something that we like and overweighting. But other than that, you are not getting much on a real return basis for owning fixed income. 2.1 for 10 years treasury, not attractive. IG giving you on average 3.2%, not attractive. So they're not compensating you on the inflation like this. So you still need to take a bit of a risk. And that will goes into equity. So equity, we are quite selective. Obviously, US, we still see, despite, where we are seeing the recent put off, but over the 6 to 12 months, we are still quite optimistic of where we are, simply because the fundamentals are still strong. Earnings are doing well. Some of the sector you can easily find companies that are beating expectation. So this is an important take. Another thing is, at this point in time, so we're entering into a market where S&P has about, 13% drawdown. NASDAQ, depending on how you look at it, where you cut off, 15, 16 to 20% cut off, kind of like pullback. So valuation, despite, still not cheap, has become much more reasonable than we entered this year. So if you look at, it's more like a 12-year basis, I think right now, actually, if you are comfortable going into this equity market as we enter this year, you should feel they are on bargain at this point in time, because they are on average 20% cheaper than where we've been in. And, depending on which subsector that you are looking into, you can easily see 30 or 40% kind of discount than earlier this year. So this is, I think, if you hold a secular view, it's actually, a good time to think about what you would like to own when all these, geopolitical risks settle, and when rate high is not going to be, is more going to be less opaque, and people are more clear about the path that the Fed would like to take.
And do you have any other comments on like these potential interest rate hikes and inflation issues? And I'm pretty sure that's going to be a hot topic at the Q&A later. But what are your thoughts on that for now?
Well, obviously, everyone is waiting for how they are going to announce this week. A few things, to our mind. First of all, I think the Fed has been quite disappointing in terms of how they control the narrative as we, talk about inflation, right? They start off by talking about this as a transitory kind of inflation. And when this word becomes meaningless to a lot of the investors, they start, going into very, hawkish about, how they want to do the rate high. And if you think about, just right before the Ukraine crisis that we've been seeing, as we enter into February, the market is expecting about 5 to 7 times of rate high. And the option market is actually suggesting on this particular week that they will have 50 basis points instead of 25 basis point rate high. And if you think about that, now 50 basis point is basically off the table. And now the market is pricing in 25 basis point for this coming meeting. And there could be somewhere around 5 rate high for the coming meetings towards the end of this year. So you do see this narrative are changing constantly about how the Fed and all the other central bank would like to tap the inflation. And this is important because, if you look in the past, if you look into the history, the Fed can only curb inflation if they can successfully control the narrative. And now we have not seen them successfully doing so. So while, we are hoping that, that the Fed can give a more clear signal about the path that they would like to take, I mean, we cannot rule out that there could be a chances of another policy mistake that they've made, for the path they would like to take for the rate high, i.e. they might, just running out of option and having a lot of rate high faster than the market expect, despite what we're seeing for the geopolitical risk. And if that is the case, what is the implication to growth? And to what extent this would affect, the United States, for example, the growth expectation. So these are, I wouldn't say our, central scenario or the base case, but it's definitely something that we cannot rule out and still on top of our list in terms of monitoring the sort of like the Fed policy or the macro risk.
And then just going back to the topic for today, right? These implications, perhaps even magnified or not with the Russian-Ukraine conflict. And I think whatever you just said is very comprehensive. And I think it gives the viewers out there both the analysis and also the macro outlook. But also, you mentioned also subsectors that could be potentials, right? Are there any sort of sectors that you like to zone into for this macroeconomic impact?
Yeah, I mean, just now we talk about like, there's still winner and losers even in this market, right? There, so like energy or financial, they are relatively behaving better in these kind of circumstances. But a few things that we need to be mindful, right? First of all is commodity price, goes up and down, right? There are reasons for you to secularly love, some of the energy company or commodity. We do see, obviously, oil price at around 100, is something that, not too far off. But, if your investment thesis is based on oil price going up, 130, 150, or even to 200, and some of the sell side are indicating, then you have to be mindful that these are built on very fragile kind of geopolitical situation. And these things tends to, come and go very quickly. And this is something that we always want to share with clients. And, we don't make commodities timing. And we strongly encourage you to have second thought if you want to, because these tends to be changed fairly quickly. So back to, sort of like the stock selection kind of thinking is at the end of the day, we want to look for companies that are still making money and have a positive cash flow. An example that I can give will be actually on the healthcare sector. So, healthcare sector to a lot of our clients, actually, they are thinking like high growth, a lot of the startup, coming up with adventurous ideas. So these are one end of the spectrum of the healthcare. And for example, the healthcare sectors that we own are on the other end of the spectrum. So we own, a lot of the hospital in the United States where they behave like utilities, right? There's a lot of predictable cash flow. Like, during COVID, valuation is down because you cannot do certain surgery at the hospital that you would like to because of COVID. But you're not going to get away from it. You still have to do whatever you need to do. It just delays. So, it's more like a utility behavior where things are just delayed, but it's still very predictable and it's very, high conviction where you will get the money. So these will be, the sort of like spectrum that we are talking about, not the high growth, no revenue spectrum, but the more conservative, making money, kind of spectrum. In that sense, even on sector like healthcare, we do have holdings where they are behaving quite well, even over the last few months.
Thank you for that, Stephen. Now, I'm interested to know, what's your team's latest asset allocation outlook?
Yeah, well, so I think this slide is actually a very good capture, right? In terms of asset allocation, we are still relatively overweighting equity than fixed income, given the risk-adjusted basis. Fixed income just not compensating us for owning a lot of it. So as I said, high yield, we can see the merit of it is improving, but investment grade credit or the sovereign side of things, they are not anything we will call it attractive. So we're still risk on, but relative, I would say, to February or just a few weeks ahead, we are trimming some of the overweight position in equity simply because as a reflection of where we are seeing a lot of the tensions is beyond just thinking about Russia and Ukraine. If you see the development of news, right, it goes to various directions. Going back to the U.S.-China dynamics. If you look at the APAC equities, they've been there's a lot of pullback going on in the Hong Kong market, in the onshore China market, right? Absolutely. It's all going back to it. And not only that, even some of the, Omicron, emergence in this part of the world could be an issue. Talking to our colleague in the West, they feel like, they've been through it. They've been resuming to normal. They've been living with COVID. But, this is something that in this part of the world, certain countries definitely not adopting this mentality or policy. And if that is the case, to what extent that will further amplify the inflation that we are seeing because of the logistic challenging, because of lockdown, to what extent it will further affect our growth forecast, because if China is not buying, right, definitely that's a problem. And if they are not shipping out, to what extent this will further impact the chips supply or the logistics supply. You might not even get your iPhone on time, right? So these are some of the things that we've been thinking, and definitely add on to our list about things to worry. So we still, relatively risk on, but it's on a very controlled and selective manner.
Okay. Well, I've got some questions already coming in from our audience, but I'm going to leave most of it for later on. But I think whatever you just mentioned, I think there's an extension question that just came up, which is relevant to it. Someone would like to know, what do you think about the China concept stock? They fell too much today.
Right. Well, I guess, by saying China concept stock, is a lot of the China stock lists either in the US or in Hong Kong, right? Where revenue are mostly driven by the mainland. Well, I guess right now it's definitely tricky because if you look at, over the last few weeks, the sentiment has been bad. And if you look at the Hong Kong market where monies are freely flow, the trading volume has been high, but the direction is just going one way, going down. And anyone who thinks, just want to go in because of cheap valuation, they need to be mindful if they are catching a falling knife. That is always tricky because the timing might cost you. If you can have a time horizon of 12 to 24 months, then maybe you can find some bargain in some of the company which are strong, basically utility stock on steroid, so you might be still able to find that. But, I would say, given the sentiment that we've been seeing, we do see there are more reason to stay on the sideline and just see how the situation will unfold rather than just go in, because the tail end risk of going in at the wrong time is just so huge, right? one headline coming out overnight can cut the valuation by 30%. And no one will have a crystal ball to tell you when or when not that headline will comes out, right? So I guess this is the most challenging part about the China related stock.
Do you have anything else to add for our viewers out there?
You mean in terms of
your insights related to our topic today?
Well, I guess again, no one has a crystal ball about how these type of tension will behave. I guess the only thing I would say is everyone has a different time horizon, right? Even every fund, every strategy, they have a different time horizon. If history can serve us any guidance, I mean, we just need to perhaps look beyond, a 3 to 6 month time frame in order to think about, how you want to allocate your asset meaningfully to fit your investment goal. And if you can hold something longer than that, then perhaps you want to, think about what are the asset class that you would like to own when things are getting better. So obviously things might get worse before it gets better, but I guess, every investor will need to ask themselves is, if things are going to get better, what kind of asset class you want to hold? And, once you have that clear, then you would like to start monitoring when is a good entry point.
Well, thank you so much, Stephen, for that. I think we've got a lot of questions coming in from the community. So I'm going to save that for later on. But for everyone else watching out there, if you have any questions for Stephen, do leave a comment in the Moomoo app and we'll get to it at the end of this webinar. So keep taking notes because we're here to give you the educational tools to help you make better investment decisions. Now we're about to give you a short live demo on how you can actually navigate the app for funds. So you've heard the analysis from Stephen, but how do you exactly get first access to Franklin Templeton's funds? So now our team will share a short slide with you. So if you have your Moomoo app with you, I'll show you very quickly on how to navigate the funds in app. So when you first enter the app, it will look like this. Look for Money Plus and click on Fund Houses on the top. Now you should be able to see Franklin on the top and you click on the icon, you'll get the full listing of the funds run by them. And over here, you'll see the full comprehensive data that you need on what you need to know about the fund house, what it entails. You'll have the fact sheet, the performance, the subscription details. And for the purpose of this webinar, of course, we'll use Franklin Templeton's profile. So if you go into the app, here's all the information you'll need to know. So general profile, NAV, net asset value. So you can calculate the change in price. Then you'll go over here, you'll see the general overview on what you can really sort of assess the general profile of the company. But then if you want to go a step further and go into the details, you can look under financial funds. And I think this is really important because you'll be able to navigate and see position details to find out more. I think it's also important to note that this feature allows you to assess the weight of each instrument, the performance, the type of region, sectors that they're involved in. So it's quite comprehensive as long as you need or are looking for that sort of detail and information. Now, for subscription, it's a great complementary tool because it helps you to gain a better understanding about the strategies and the concept of the fund house. And my personal favorite, the news feature, which I think is excellent to help you stay on top of all the news, the buzz, the keywords that are surrounding this particular fund house. Now, this is the entire composition across all media channels. And so you have the summary and you'll be able to click each article for further details. Now, I understand sometimes it's overwhelming. And maybe you like to take a more macro approach. So in that case, navigate to summary. And it's essentially the basics. You get the country, the fund documents, and over here, the fund managers. Now, if there's one key takeaway you take from this demo, I'd like to leave you with this. So in determining a fund house to invest in, I think it's crucial to both measure performance and find someone you can trust to manage your portfolio. And so this is an active management portfolio feed. So you'll be able to access the credibility and details of the managers involved. It's a great tool. And I think, it helps you to find someone and the right person to help you invest your money. Now, if you have any questions about this feature, you can always message our team or leave us an email and we'll get back to you. All right. Now, I would like to invite Stephen back into the room because I think this is the most exciting part of the webinar. I love taking questions from the audience. So welcome back, Stephen.
Sure.
Our viewer would love to know, will the U.S. capital markets benefit from the war between Russia and Ukraine? I think we did cover a little bit on this, but do you have any additional thoughts for this question?
Well, yeah, I mean, there's a few ways to look at it, right? First of all, you might want to know to what extent, there's any direct exposure for some of the sectors that we talked about, like in the U.S. that are Russia related. Obviously, the energy side of things might have more relevance on that because, Russia and Ukraine being one of the, energy exporter to a certain extent. So to that end, this is one of the additional reason why you see the energy sector has been doing well. But again, that has to be mitigated by, the ups and downs of commodity markets. And, if you are thinking about going in now, you need to be mindful that, the kind of valuation that you are paying is actually on the high end. So chasing after momentum is always something that you need to be mindful of. But if you look at broadly in terms of the U.S., actually, if you look at, say, in terms of revenue contribution, Russia or even Ukraine, they are, fairly low in terms of, to what extent they will contribute to it. So I would say the major impact for these conflict obviously is a disaster. No one wants to happen, but then it's more about the narratives on inflation and the growth expectation to the U.S. And we do see it's already reflecting in terms of inflation. So, I mentioned about, the oil price keep going up. So you even feel it in Singapore, right? If you go out, try to recharge your car, the vehicle, so it gets expensive every day. So these are, something that, we are already feeling in terms of where we are getting at. So the second thing is about growth expectation. So the combination of Ukraine-Russia conflicts, the potential China knockdown because of Omicron, and all these U.S.-China kind of a stock sanction that is resurfacing on the stock market. These few factors actually all contributing to the growth expectation and the sentiment of the market. So I would say there's no actually countries or sector that can get away from that sentiment or that headwind. So to that, I guess this is one of the main reasons why we are seeing, the equities market are pulling off so drastically and quickly, especially not just in the US, but even in the Asian market as well, in particular like Hong Kong and China.
And is there any chance of recovery for Q1 to Q2 in terms of the markets?
Well, Q1 is definitely, we are approaching the tail of Q1. So, we only have another 2 weeks left. So given where we are for all these, uncertainty, I would say, it's quite tricky, depending on how we define, recovery, definitely, kind of slim if you want to go back to the beginning of this year. But, we might see signs of improvement of the situation. We can never rule out that, especially if the Fed, as I said, can give us more guidance on how they would like to contain inflation and the path they would like to take for this rate hike that will help. Another will help is any signs of dialogue that we've seen will bring to like some sort of, signs of the end of the tunnel for the Ukraine-Russia situation will be helpful. I guess right now, the market are waiting for that, and every signs of that, the market will take it as a as a tailwind. So we shouldn't rule out that. And if these two things happen, then I think we definitely, don't want to be too pessimistic for the next quarter.
One viewer would like to know, in the current political conflict, which industry are you more bullish on the development of their stocks? Now, today's Hong Kong stocks and Chinese stocks are down a lot. What can we invest in to help regain confidence?
Well, I can only share with you where we are, having overweighting or underweighting right now. So within the equity space, right, we still favor developed market versus emerging market. So Hong Kong is tricky because you might think, it's more towards developed, but, over the development of the last few years, especially on the China side of things, it behaved more like an emerging market, related to China. So definitely, we currently favor the developed market equities like US, than the emerging market. We believe, emerging market are suffering all the headwinds that I just shared about, the geopolitical risk, the rate hike, the lockdown, but to a worse extent because, the revenue for a lot of the corporate fundamentals, they are less solid than what we've seen in the developed market. And obviously, a lot of the emerging market are suffering directly from this geopolitical tension, right? Take China, take Russia, and take a lot of the LATAM country as an example. And if inflation is bad for America, inflation is even worse, to a lot of these emerging markets, given the central bank has less tool or vehicle to help them to mitigate that. And they are, greatly affected by the Fed policy in terms of rate hike. So that's the reason why we are favoring developed market over emerging side of things. And, I do think, that view might be stick around for a few more months before we see any signs of improvement.
Thank you for that, Stephen. For the next question, also related, I think it's a bit more specific. It's really two questions. So one viewer would like to know, how long do you think the impact will last on commodities in general? And do you think the price of energy-related commodities will continue to rise despite interventions by governments around the world?
Well, that is a tricky question, right? So if we look at the energy, say the oil price as an indication, right? If we look at, last night I looked at the sell side estimate, they are ranging between $80 to $300. So we're seeing a range of like this, right? So now we are at a point about $100 per barrel, right? So and now we are, in the US, the inflation is about 8%. So you think about, if oil goes up to 130, or which we've been seeing, over the course of the last few weeks, right? To what extent inflation will go up, right? So these are tricky. I would say that definitely the government will seek every means to bring it down, but you need to think about what kind of options they have, right? If you look at the US, it seems like some other viable option will be to ask other countries to increase supply, and that option doesn't leave them with many countries, and it will take time because it is a government to government dialogue. And another factor that I think a lot of the investors are not appreciating enough right now is, as we enter this year, one of the main items that people are talking about will be ESG development. And obviously, because of that ESG development, people are supposedly to be building around policy will have less reliance on oil and things like that. And, that means a secular downward trend to a lot of these commodity price. But now as we enter into this geopolitical tension, will we expect the world as a whole to remain as strong, asking or pushing for this ESG agenda when we see there is a cause for it? Will we be willing to settle for a lower or slower kind of pace in terms of replacing that? So these are all critical elements I think we need to think about when we try to figure out the path of energy. But from our side, we definitely, are quite skeptical to say, oil will go up to 300 barrel. But we believe, the current level will stick around for a meaningful time.
Thank you for that. Yeah, I think it's a complex one. It's tricky, particularly this question. But I think you definitely help the viewer help to really summarize this complex question. Thank you to the audience members for your questions. Keep them coming, because I think it's great for discussions, and it's very important because you are helping other people watching this in terms of their analysis and their own investment decisions. So back to a viewer's question. So number 6, what would be the US S&P 500 and the Hang Seng Index outlook for the next 1 year? And does it make sense to invest in them now?
Well, giving timing advice, I was told it's always tricky because everyone has a different investment horizon, right? Looking out for 1 year, I would say it's more closer to a longer term kind of asset allocation decision, and to that end, I would just reiterate about the point that I've made is we definitely favor developed market over emerging market, and then there's reason for it, right? If you look at the sort of like the earning estimate that we've been seeing, and the sort of like the growth expectation that we've been seeing, developed market are much more solid than the emerging market and the emerging economy. This is important because, as I said, right, there are 2 factors that drive the equity markets up. One is about revenue earning, like how much the company can make money. The second is how much multiples the market would like to give. The later one is tricky everywhere, right? US, you see the growth stock valuation are being trimmed heavily. In Hong Kong, in China, is being trimmed even more heavily in terms of multiples. So at the end, you need to look for the sort of like strong revenue earning as sort of like the something to fall back on, and sort of like the more defense that you want to hold on. And this is the reason why I cite the example about healthcare. Right, you can easily identify, both growth element in a lot of this company and also the kind of value element in some company. And we do see the so-called value elements of it, the kind of valuation, earnings that they've made relative to their pricing, the price to book, right? These are important metrics at this point in time because investors are really going to look into the bottom line at the end, like how much money the company is making and how volatile or how vulnerable it is, than the environment that we've been seeing. And to that end, we think that definitely only companies that are making meaningful revenue and earnings can sustain. And we believe, it is relatively easier to find this names in the developed part of the world, in US, than the emerging part of the world, like in China or Hong Kong right now.
Mm-hmm. Well, I'm personally interested in Asia Pacific and even the developing economies here. Is there anything you can say about the macro outlook? In relation to our topic for today?
Yeah, of course. Well, we do, it's funny because when we have the investment symposium, late last year, where all the CIOs gather and talk about some of the key items that we want to think about, not just for the next 12 months, but more important for the next 3 to 5 years, more like a secular outlook. Everyone talks about the emergence of APAC as a whole, not just China, but also, Southeast Asia, Singapore and the countries around it. The composition of it is at a very sweet spot point, right? If you look at the demographics, if you look at the composition of the people and the growth potential, it's all huge market that could be a additional force to the economy and the growth. So if I can find one common point that a lot of the investment team are sharing within our firm is everyone has a optimistic and positive view on a secular basis for this market. The tricky thing, however, is when it translates into investment, a lot of this market, because of its nature, they are still by definition developing, right? If you look at a lot of the emerging economy like Vietnam, like Indonesia, you don't see a stock market with the depth that you see in other parts of APAC, like Hong Kong, like Singapore. So you need to be mindful about, what that means in terms of volatility. But, if you are not too worried about shorter term volatility, and if you share our view about 3 to 5 years, sort of like a secular outlook, APAC, especially in the Southeast Asia region, is definitely something that on top of our mind, and, still remain a very kind of positive view towards that.
Oh, I've learned quite a lot of things from today. Thank you so much, Stephen, for that. Do you have any final thoughts for our viewers out there?
Well, I guess the final thoughts will be, one thing that I find quite common is, when we are being asked about, do we do this or do we do that? One fundamental that is missing is more like the investment horizon, right? Again, the shorter the time frame, the harder actually to make a prediction or to make an expectation. We call this, not estimate, but more like a guesstimate, right? But if you actually can form a longer time frame, right? As we just discussed, you can form a secular view about things, right? What kind of things that won't wake you up at night if things go south for a short while, but you are willing to comfortably hold and sleep peacefully at night on a course of like 3 to 5 years, then perhaps, to a lot of the retail investor out there, these are, the asset classes, the geographical regions, or even, the countries that you would like to own for a long period of time. And then that could really, change a lot of the perspective that we've been talking about today.
Well, thank you so much, Stephen, for joining us for today's webinar. And for viewers out there, this is the first of the 3 days of webinars we have for you every 7 p.m. So tomorrow, do join us because we've got another exciting topic. If you want to know more, you can always log into our Moomoo app or go onto our Facebook page for more details. Now, remember, we're here to help you and provide you with the educational tools so that you can make better investment decisions. And I think even for myself, I learn a lot from these webinars. And I think keep joining the discussions and be a part of the analysis of key important topics that are hot right now in the investment world. And I think it's definitely added value today. So stay tuned for more webinars like this. Thank you so much, Stephen.
Thank you, Olivia. Bye-bye.
All right. So we'll see you tomorrow at 7 p.m., everyone. Once again, I'm Olivia Higgins, and I'll catch you later on. Bye.